All right, guys. Look who we got. We got Tim Kloss. Before we get a little bit into stocks, I just wanted to show my man and the Eddie Line Brewery.
Oh, there we
I
go.
looked into it, Tim. I went there. I got some beers. You know, I had to get some. So
Good
appreciate you
for
definitely
you.
telling me about that
You
brewery.
guys are like neighbors, eh? Money Mitch
I
and
gotta
Tim
come up,
Quas.
man. I
You
gotta
gotta
come up
come
to
and
the
see Tim.
mountains. Come spend
You
some
guys are like
time up
next
there.
door neighbors.
It's 42 degrees here this morning.
Yeah,
So
beautiful. It's getting beautiful, right, Tim?
Right, coffee by the. I've actually got the fire pit going out on the deck,
Ooh.
and so you can start the
Sky
day with
man.
coffee out there by the fire pit, and then take your eddy line down and float the river. That's a Colorado lifestyle.
Holy, I gotta move to Colorado. That's where I gotta be. You guys gotta live in the dream out there, man.
What about Northern Michigan, Tim? You ever been to Northern
Joel,
Michigan?
Colorado
to
life.
Michigan. We know what
No.
Joel's favorite state is.
Well, Joel, I hear that I want
gorgeous.
to go to Traverse City. I've never been.
That's
to
where I
Traverse
was
City.
this weekend. I was
Is
north
that
of
right?
Traverse City, Northport. I'm telling you, actually, I swam in Lake Michigan. I was the only one of our group. 60 degrees, man.
Your
was
life may be complete now.
no, man, oh man. After 22-mile bike ride, I'm like, I'm going in, and they're like, you're not going in, and I went. But you got to get up there. The Northern Lights. Oh my God, I must have saw 8,000 stars there on Saturday night. But let's talk markets, Tim. And you kind of like it, or you think there's a potential here for Tesla? Let's talk about your Tesla setup.
Okay, we can talk about Tesla, and the setup to this is Mark Twain gave us a lot of good lines to use, and one of them, to paraphrase, is that you and I collectively know all there is to know. You know all there is to know, and I know the rest about this. So I don't know. That may have fallen flat. But let's talk about. I saw too that you were talking about Clover and Workhorse and these. They're
Reddit
we
names.
continue to see stocks that move in ways that defy gravity and what you would expect from supply and demand. We could talk about that. I'll give you this little tease. If you're trying to do a remodel project and you want to get lumber for it, not only is it very expensive, but instead of being able to get it in 3 weeks or a month, now it takes 10 weeks or 6 months. And how come that doesn't happen in the stock market? If the supply of something is strained, why doesn't it take longer to get it? It's something we should ponder.
Yeah.
And we can come back around to why that's true. But let's
Well,
talk
you can
about,
always get supply if you move the price up enough.
But what if no one sells?
They always seem to, though. Joel used to teach me when I first started Bright Train 1999. He's like, you don't always find a buyer for a stock that's going straight down, but you always find a seller for a stock that's going straight up. You always seem to find somebody always willing to take profits.
It's the human fear and greed are two of the most consistent pillars of our existence. There's no question about that. But to me, this is why market structure matters. If traders are going to navigate the market to the best that we can with the best probabilities of returns and the best protection from the unknowns, it is necessary to have a baseline in the rules, market structure, the behavior of money behind price and volume in context of rules. And so if we began with Tesla, so let's talk about Tesla. Notice this is I forgot to change this title. Let's do that really fast. And by the way, traders, you can do this. Just come join me. So go to marketstructureedge.com, put your name and email in. Doesn't cost you a thing, and you can walk along with me to see what we do here. By the way, it's very easy to add things to the portfolio. Listening to your conversation, I added Workhorse and Clover there. So let me go here and look at Tesla. So Tesla is actually at the top of this list, and this is a portfolio, and it will rank things by default from the lowest market structure sentiment, which is a gauge of supply and demand, short-term supply and demand. We're not looking 6 months out. We're looking about 10 days out. What happens 10 days from now, roughly, in Tesla? Well, if it's bottomed and 4.2 and short volume is below 50% and passive money is the lead behavior, it is probable that Tesla is higher 10 days from now. It's not an absolute, but it's a very good rule of thumb. And the time to leave Tesla was when it peaked, or here at 10. This is when you leave. You pick up shares when it's oversold, and you leave when it's overbought, and you just continue to repeat that pattern. And so I would look at Tesla and say, I'm watching this now. I prefer that stocks drop lower than 4, because if you're just at 4, you've got sort of an equalizing of supply and demand, which then diminishes your upside. But all other things being equal, I would look at Tesla and say, that is going on my watch list. I might even create an alert to tell me when Tesla's market structure sentiment ticks up, because that's the opportunity. So let's go in the same vein, since we're talking about these stocks that have strange characteristics that really defy the broader market, and we look at Clover, which clearly was the thing to trade last week.
Right.
Here is market structure sentiment looking over 30 days. And interestingly, you could do the same thing. You could, if you were right on top of this and watching it, the best time to buy something is about when sentiment ticks up, and particularly if short volume is way below trend. Notice that this short volume is the amount of trading volume coming from borrowed stock, and it gets to why, Joel, your adage about greed always motivating people notwithstanding, when market makers manufacture stock, they have an exemption from Reg SHO Rule 203(b)(2). Repeat that over and over. They can manufacture stock to fill infinite orders, which is the trouble with trying to short a stock that becomes like this. But this condition could affect anyone. It doesn't have to be Clover Health Investments. It could be Ford. It could be GM. All stocks are subject to this because market makers are exempt from the short locate rules. That means,
I just want to clarify, because we were getting a lot of questions on this, but this is only for the until 2-day settlement, though. So they have the exemption, but then they are not exempt from, I don't have that in front of me now. I was actually reading the SEC release on Reg SHO, but they cannot stay short if they can't find the locate after 2 days.
No, they have 35 days. They have trade day plus 35.
Why is that? Because when I read Reg SHO, Tim, I don't read it like that. Let's bring it up.
Let's read this. So here's what you have to, if you want to find this, traders, here's what you have to do.
Because the exemption is clearly in there in Reg SHO. You can read about the exemption. Tim's absolutely correct with the exemption.
Right, market maker exemption. So you really have to dig deep to understand this. But here's the thing: market makers engaged in bona fide market making. They're the ones who selling stock short without having located stock for delivery at settlement. Can you do that? Well, yeah, if you're a market maker, you can. Now you have to dig deeper into the actual exemptive orders to see that they have T plus 35. Now, why is that? Well, it's because this is an essential concept for traders to understand, that because regulators wanted a continuous auction, that is, there is always buying and selling occurring. Well, how can that possibly be true? And I like to use this analogy of an art auction. First of all, somebody has to be willing to sell a Wayne Thiebaud. I met with Wayne Thiebaud one time. One of his paintings is sold for $19 million. He's passed away. But if you want to buy a Wayne Thiebaud painting, there are only so many of them, just like Bitcoin. There is not an infinite supply of Wayne Thiebaud paintings. So somebody has to put it on up for sale, and an auction house will manage that, and people who are qualified to buy it will show up, and a bidding process will begin. That is the opposite of a continuous auction market. Right? That's like an opening auction or a closing auction, and the painting is sold and the buying and selling ends. Well, that is not the way the stock market works. The stock market between 9:30 and 4 Eastern time is continuous buying and selling. Well, what if there's nothing to buy or sell? Well, that's what the DMMs, the designated market makers on the floor, are paid by the NYSE to make sure that does not happen. They become supplemental liquidity providers, and other broker dealers can become supplemental liquidity providers. What does that mean? It means if we run out of supply of something, somebody will be paid to furnish it. Well, where does it come from? Right here in the rules. They're exempt from having to locate shares to borrow. It even goes so far as to say is naked short. You can look at this, get market maker exemption, naked shorting. And you will see that they'll say, well, not all, at all times is naked shorting illegal because the market depends on it. A retail liquidity program, what happens in that? Well, that's where your limit order, if you're at Schwab, goes into a pipeline and is immediately sold to Citadel Securities or somebody like that, who now knows where that order is priced, but they own it. Right? So when they can say, looking at the supply and demand in the marketplace, what is my willingness to fill that order here? Well, if I can look around and see that there's enough demand that it will push the price there, I'll fill it with shares that don't exist. And I can do that over and over thousands of times a second until supply and demand equalize, and then I'm out. And the NYSE and other exchanges will pay them through a retail liquidity program to be the best offer to sell, because that is the best price in the marketplace. This is also, you don't have to know this, but you want to be comfortable that somebody does, and we do. Market Structure Edge is backed by all of this data, so we understand the effect that it will have on how stocks behave. That's what happened to Clover. Here's what happened. Right here is the manufacturing of supply to fill these orders. They could see it coming. Now, it's going to continue. Look at that. I would have left right here. Soon as the trend goes above the line, I know that they're manufacturing artificial shares for buyers, but that also means the market will equalize. And so I leave. That's how to do it, traders.
I'm digging into Reg SHO right now, and and it's very good that you've brought this to our attention here. The market maker exemption here. It says for an ordinary short sale, the stock must be located before the short sale can be executed. Correct. Obviously, we know that. However, bona fide market makers, which is what Tim is talking about here, are exempted from this rule and can short sales without locating the stock. This is naked shorting, which, if executed in accordance with the rule of Reg SHO, is legal. When these rules are not followed, it becomes an illegal naked short. If the stock involved in the naked short can be located and borrowed in the 2-day period before settlement, it just becomes an ordinary short sale. However, if the stock cannot be located and borrowed prior to settlement, it creates a fail to deliver situation. If the case of a fail to deliver, a broker-dealer is supposed to take cash from the short account and purchase shares in the open market to close out the position. Now, bona fide market makers who are perceived as providing liquidity to stock trading can maintain naked shorts for a longer 6-day period, it's saying here. So so that's, you've got 35.6. This is when you get really deep down to the rules and trying to uncover. And I'm not a market maker, so these rules don't apply to me. So obviously, we're really digging down into the ditches now, trying to find out, how long can they hold on to those shorts without finding the locate for? You're saying it's 35. This page is saying it's 6
days.
We're still trying to find out the numbers of how long they can hold that for. It isn't an infinite amount of time, though, obviously, because you think it's 35, so it's not infinite. We're just trying to find how long they can hold it for.
It's not infinite. The question is, can market makers be squeezed? It's a fair question.
Yeah.
Well,
it's a different situation for sure. They get squeezed because no market maker wants to hold AMC from 10 to 50, so they can definitely be squeezed to lose money. But can they be forced out of their position?
Exactly. Well, here's the thing: they don't have to return shares to anyone. That's the issue. They don't have an obligation to return them. Plus, as you know, Dennis, these traders generally are holding shares for fractions of seconds, not for days and days. So who ends up with that obligation? What's more, if you're a proprietary trader, rather than if you're a riskless principal or you're a full service broker dealer, what those terms mean, traders, is you're handling customer orders. If you're handling customer orders, it's illegal for you to front run them. That is to put your own interest ahead of your customers. If you're a proprietary trader, you can do whatever you want. So if you create a supply of stock for CLOV to fill trades that are in the pipeline, then you can offset it with something else. So if I know I've got an obligation on my balance sheet potentially way out here, what am I going to do to mitigate that? Well, that is a liability. How will I offset it with an asset? Well, I will go long something else that's moving the opposite direction so that I constantly reset my teeter-totter. Virtu explained this to me 3 years ago with what they said they do with their models. They said we are continuously sifting the market, and it's very similar to our sentiment model. They said we're looking for stuff that are 4s that are becoming 5s, and we go long those things, and we look for things that are 6s that are becoming 5s, and we go short those. And at the end of the day, we want it to be 0. And when you introduce this idea that they don't have to locate stock, all that matters is, do we get to 0? That's it. I know it's hard to wrap your head around it, and you don't have to worry about that, traders. This will tell us. The beautiful thing that is, I'm biased because this is my platform, but it doesn't matter how much prices move. Sentiment isn't going to gyrate beyond 1 and 10. It's always going to tell you when the conditions are risky. The conditions are clearly riskier up here than
One
they
thing
are
to
down
consider
here.
too, Tim, like, do you honestly think there's market makers that are just holding this stock short from 10 to 70? Do we think it's the market maker? Because market maker, to understand, and Joel, you were a market maker, you're always wanting to flip. You're always wanting to flip. Market makers aren't in the business to pick up pennies and lose
No way.
thousands of % here.
So, and if they do, they're getting rolled over.
I think it's unreasonable to think that we just have a bunch of market makers that are just getting killed on this. I think it's more reasonable to think, and people don't want to hear that, the market makers are still able to flip AMC probably fairly easily, that they're being able to buy on the bid and sell on the offer. And in all likelihood in this AMC, it's the market makers that are still probably making money on this. I think it's, and I think if you asked, I think, we saw this with GameStop back in January, where we had the one Bloomberg reporter that came out and was saying and showing that, it was kind of equal, and that Citadel was actually doing very well through the whole GameStop situation. What are your thoughts on this?
No question.
No question.
There's no question that market makers who understand supply and demand and who can stay fractions of seconds ahead of the market have a huge competitive disadvantage. And I've brought this up to the SEC around what's called regulation fair disclosure, something that the corporates, issuers have to comply with. It was created in 2000. You might say, where is Quast wandering to now? I want to explain this.
This is fun. We love you, Quast.
The idea of Reg FD was that the big sell side analysts like Henry Blodgett, who founded Business Insider now, he's been able to rebirth himself, and Mary Meeker and folks like that 20 years ago, they had inside information about IPOs and where those things were going to go, and they let people have access to them. And then big public companies had very close relationships with analysts and would interact with them. And the SEC looked at this and said, there's an informational advantage for institutions and sell-side analysts. Well, we can't have that. And remember, this was the period in 2000, right when webcasting earnings calls exploded. And in some cases, tens of thousands of retail investors would show up for these things, like the Yahoo call with Tim Kugel. And so that rule was put in place to get rid of this informational advantage that audience had, public companies and sell-siders and institutions. Step forward 20 years, and who has had the informational advantage since Reg MS was instituted? And it gets worse and worse. It's the market makers. The market makers know things nobody else does. They own the pipeline. When Robinhood or Schwab or E-Trade or Ameritrade, those things are, E-Trade's owned by Morgan Stanley, Schwab and Ameritrade have merged. Robinhood's got 20 million accounts. They're all selling their order flow to people who now have an informational advantage, and they're never, ever going to get caught out. Virtu in its S3, its IPO filing, this was years ago, reported that they had 1,289 out of 1,290 profitable days. They had one losing trade day in 5 years.
Yeah.
How does that work for you? So
very consistent.
Right. So why is that possible? There's only one way that is possible. It's not luck. It is having an advantage. And so when Citadel looks at the pipeline and goes, oh, those are equalizing, they're no longer the ones exposed to all the stock they created. Somebody else is. And what will happen invariably is it's going to go down. It is very basic math and economics that's going to happen. So is that good or bad for the market? Well, I don't think it's good. I mean, if Bitcoin is good, then this model is bad.
Yeah.
And vice versa.
I mean, we're very reliant, and we've talked about this on the show over the last 7 years too. We're very reliant on a very few number of firms for the majority of the market's liquidity. So when you look like the majority of the liquidity, like you think about what the NYSE floor looked like 25 years ago, and you think what it looks like now. I mean, we went through from hundreds of market making firms to basically how many are on the floor now? 7? How many do we have on the floor left?
Well, if you're talking about core market makers, the designated market makers,
just a very few. 4. Is there 4 now?
And they're all proprietary traders because the NYSE floor rules prohibit opening a stock with a customer order. That's why you get these massive fluctuations at the open versus the close. In the close are all the orders trying to get to the reference price. But yeah, you've got Virtu, you've got GTS, you've got Infinium, and I'm forgetting the fourth one.
Well, Citadel.
Citadel. There you go. So there's
the big gun.
The biggest one of all.
The gun that's on the other side of majority of your trades.
There
everywhere.
You go. And sometimes these 3 of these 4 are 75% of volume in a given stock. It's the craziest thing in the world. And yet nobody is paying any attention to it, save here.
Well, it's like an oligopoly, really. I mean, we've come from, like, we're not a monopoly here yet, which Citadel would love to have a monopoly here, but you're at an oligopoly where you've got 3 or 4 major players that are controlling pretty much everything.
Exactly. So, yeah. And there's a symbiotic, we're going to run out of time here, I know, and I want to leave you with one thought about where the market is going too. But there's a symbiotic relationship between those firms and the SEC, because the SEC, when it propagated Reg NMS, Regulation National Market System, a market-wide system of interconnected electronic markets where marketable trades have to, by law, be automated. And now 95% of trades are running on algorithms. And if you want to be at or between the best bidder offer, it's got to be automated because that's the law. Why? So it can flow to wherever the best price is. You can't do that manually. And so what is the mechanics that operates that market? Citadel, Virtu, GTS, Infinium, Quant Lab, Hudson River Trading, and so on. And there are 15 of those firms, and there are about 8 broker-dealers running 85% of customer orders, and the whole market depends on that group, as does the SEC, because this market does not work without it. If you did away with that exemption, the market would have no liquidity and we would have violent moves.
So there's a reason for this exemption, which does make sense. Like, I understand from a market making perspective as well. Obviously, like I said, Joel was a market maker I've worked with. When Bright Trading was formed back in 1993, it was formed from all market makers from the floor. So, you get the history. The rules change over time. I mean, the Reg SHO was 2005. So they keep changing over time. So we've got to keep reading and understanding.
And 2009.
In 2009 as well. But, obviously, you got to keep reading and understanding the rules as you go along. But again, they have those, there is an exemption there. Those rules don't apply to all the hedge funds that we're talking about there. There isn't a market making exemption for a hedge fund. There's not a market making exemption for Bright Trading, but there is for these designated market makers, these few firms.
And that's why those hedge funds are getting killed. They don't understand the market. There are too many people in the market who don't understand how it works. And that's why, by the way, traders, that's why you use marketstructureedge.com. It's because we do. Now you're part of the cool kids. Because this stuff affects how the market behaves. And I know we have to run. I want to leave you with this. Look at this is for risk management. This line right here, this is broad market sentiment for the stocks comprising the S&P 500. Here's the trouble for the market. A healthy market moves over 6 and back to 4. That gives us great trading opportunities. Look what has happened since mid-April. Look at that downtrend. We can't even get over 6. That is a problem. And it could lead to a major market correction. I'm not saying it's going to happen.
When you say major, what are you thinking? Like 10% type deal, like a correction? Like they say an actual market correction is 10% is what, they kind of quote us. Is that what you're thinking? Like a 10%er?
Random number. I think it could be worse. I think if this begins to, what happens if it begins to crumble is Citadel and Virtu are out and then you don't have any prices and the whole thing can tip over. I'm not predicting that that's going to happen, but every time that we have in the last 10 years struggled to get to 6, it has preceded a market correction. So it is highly probable that we have a move down ahead. Again, this could be the exception to the rule. But I also look at the amount of deviation, standard deviation in prices between stocks and ETFs, and I think we could have real trouble. So be wise.
Thanks, Tim.
Great
Thanks,
stuff,
Tim.
Tim. Great stuff. Thank you so much.
Good to see you.